Good morning, everyone, and welcome back to the Money Mentor podcast with Graeme Holm and Dr. Andrew Wilson. And good morning, Doc. What's happening in the economy and the property market in almost mid-July?
Yes, mid-July, Graeme. Hello to you and hello to everybody.
Good morning.
It is the middle of winter, literally now. We are the second week in July, which, of course, is mid-winter in terms of the middle of the season. And we've had a few surprises, certainly in respect to the housing market over the last week, Graeme. Of course, we expected to have a little bit of a quieter period, as we usually do, through July and into August. And, of course, we've had quite a strong autumn selling season as a preview to that quieter period. And no, we've got buyers coming back into the market, Graeme, as evidenced by our auction clearance rates and our auction activity last weekend. We won't give too much away because we'll talk about that at the end of the show. But,
we always
just
give it away too early, Doc. We give it away too early.
Well, I know that. I have no self-control, Graeme. That's always been my problem.
We get too excited.
You can read whatever you like into that one, but yeah, we've certainly got some good news, midwinter news in terms of the housing market. So it's not that much of a challenge as it typically is in July for sellers to find a buyer, because there's still plenty of buyers around. And it's interesting that there was, once we did start to see those signs towards the end of June and into July of an easing in housing market activity, which is seasonal. A lot of the negativity in terms of the doomsayers were back up and running again, like, oh, yeah, we told you it wouldn't last, blah, blah, blah. Well, that lasted a week, that sort of doomsayer chant, and they're back to just being very, very quiet at the moment. But, of course, we've got another weekend coming up, something to look forward to, our results for next weekend. But I've given it all away. I told you I have no self-control, Graeme, but we will work through. But what we did have with new data today is the June rent report. And, of course, the rental market's been a big focus over the last year or so. We're seeing rent increases as we've never seen them before across the board, all capital cities. We're not alone here. Yeah, it is. And in times of, high inflation and prices rising and higher interest rates, perhaps that doesn't affect tenants that much, but as much. But obviously as owner-occupiers and investors. But certainly it's tough times for tenants going forward. And, as we've discussed, Graeme, this can really mean a significant change in our housing market and our society going forward if we have these long-term struggles to house our population. And, we've looked at the factors behind this. Of course, we've resumed our migration patterns since lockdowns have finished. Our borders are open. We have a remarkable surge in migration now coming into Australia. The problem to that is that we just are struggling to find roofs to put over these new entrants' heads because we've underbuilt for so long now, and even underbuilt in terms of the long-term trends compared, with all that building we did with Home Builder in 2021, if you remember the previous government's policy. But we're now back to, down, and down. And this is a big problem when we've got so much demand and new demand coming through. And we're really, really struggling to match that demand with supply. And, of course, the joker in the pack is our building costs, and not just all the issues that have been slowing down new home building, such as planning restrictions, red tape, green tape, all this sort of stuff. But now it's a struggle to make a profit for a builder because of high building costs, even if you do get your building approval through. So just saying that, Graeme, and we're going to look at some building costs today as well. Just saying that, next week we're actually going to look at something a little different, and that's commencements. So we're going to see what the relationship, because we've got the latest commencement data coming out this week from the ABS, building commencements, home building commencements. So let's see if those commencements are keeping up at the same typical rate as approvals. In other words, are we getting fewer commencements per approval?
Well, that's the big concern, Doc. We talked about this the other week, that we get all of these approvals flowing through, but hardly any of them equating to an actual commencement or a start now. The big developments that are getting approved, the high-rise stuff, it's just not feasible or cost-effective right now. They can't build for a profit. And we're seeing a lot of it in land subdivisions. There's a lot of development sites that are approved that they're trying to sell right now because they can't build and they can't get a builder.
Yeah, well, this is the issue, that normally we look at building approvals as home building approvals as a reliable forward indicator of supply. But of course, it's just an approval. It's not actually a job commencing or a job being completed. But we've taken that as being reliable because the difference between a building approval and a commencement is usually the same. There's typically fewer commencements than approvals, but it's only a small proportion that don't become commencements in the same sort of time frame we would expect. And they're postponed or, but it's only a minor. But now if that increases because of high building costs, then we have to reevaluate just exactly measuring or modelling approvals to tell us what supply is, because it might not be reflecting what the supply coming through is. So, are you excited, Graeme? We're going to have a look at that next week, that latest commencement data, just to see the correlation between the two. But we'd probably better get started on today's.
Let's but next week, guys, make sure you tune in next week, because that will really dictate the ebb and flow of stock or homes in the market. Yes. So tune in for that from Doc and I next week. But let's kick off, Doc, because you and I can talk about this like a underwater with a mouthful of marbles. We love it.
Something like that. But so my housing market's latest insights into the housing market for this week. As we mentioned, Graeme, we have the June rent report, the month of June. Some interesting results, Graeme. Of course, we know we've really had almost a non-stop period of increasing rents over the last year or more. Again, it has a lot to do with a lack of supply, as we've just discussed, increased demand, and the adjustments that have happened as a result of the end to lockdown, particularly in Sydney and Melbourne units, which were certainly suffered through the COVID pandemic period, lockdown period, where there were plenty of vacancies. Of course, there was no demand from students or business travellers, and the Airbnb landlords shifted into the permanent market. So there was a flood of Airbnbs that came into the permanents, and they were very much typically, inner Sydney units and CBD units in Melbourne. But of course, once borders opened and travel started again and migration started again, and we're seeing perhaps a little bit less of the energy from the work from home, which increased demand for houses. So there's a shift now to units, but that's what's created this surge in rents over the past year. But we're not alone here, so it's not just our issues, local issues. We've seen the same sort of shortage of rental properties in the US. Some of the big US cities are suffering the same, and they're seeing rents skyrocket as well. So rents are rising and rising. And here's the data for the month. We had, and what was interesting, Graeme, is we've got to understand that June was a holiday month, right? We had the monarch's birthday, the king's birthday holiday, just about everywhere. We had the beginning of school holidays, of course, at the end of June. And that tends to have an impact on our rental market because tenants and landlords are distracted, particularly tenants. So a few of those decisions to move or to secure a new rental property, are put on hold until those distractions are eased. And what we see, interestingly enough, is a change in vacancy rates. And vacancy rates did rise almost across the board in our capital city markets over June. And that's because of that holiday effect. So let's have a look at the rents. Sydney house rents flat at $750 a week, but still up by 13% over the past year. Of course, we know there's been big demand for house rentals because was generated by the work from home, the home office demand through COVID. The vacancy rate still very low, even though vacancy rates increased over the month everywhere except Hobart. capital cities are still very, very low, Graeme. So even if we get an improvement in the vacancy rate from the tenant's perspective, and of course that's a higher vacancy rate, they're still, at record low levels. Look at those numbers. They're just crazy. Hobart's got the highest rental vacancy rate and Canberra at 1.5%. That's the high one.
Doc, have you ever seen vacancy rates nationally across the board this low in your career?
No, Graeme. This is because of the one-off effect of COVID and the rebound that we're getting that's driving demand, and the longer-term systemic problem that we have of undersupply. And of course, there's a myriad of other things, and we could talk about that as well in terms of the restrictions that are being put on investors through government policies, taxes and charges that are creating a disincentive for investors, which is cloud cuckoo land stuff. When you see these vacancy rates, we don't need fewer investors. We clearly need more investors, to stop this almost never-ending increase in rents. That is a product of low vacancy rates. And look at these vacancy rates there. Melbourne, 0.7%, Brisbane, 0.8%, Adelaide, 0.4%, Perth, 0.5%. These are ridiculously low numbers, Graeme, which are virtually saying that at the minute a property is advertised, it's rented out. There's just no, the level of demand versus supply is so mismatched that it's, clearly in the realm of, in terms of power of the landlord, and the tenant has to keep paying more rent. And the only thing that's going to stop tenants paying more rent will be their financial circumstances. So obviously we can't continue to see these types of rental increases because people aren't making that sort of money extra every week. Yes, wages are rising at the strongest levels in over a decade, but tenants can't keep paying this extra $10-20 a week that we're seeing rents increase.
Well, Doc, surely units have got to be cheaper. Surely units are cheaper, Doc.
Well, that's the issue. We actually saw some relief. We're starting to see some relief from the unit market, Graeme, particularly in Sydney, where units have been tracking houses now for the last month or so. We'll look at units in just a sec. But I do think that that's part of the story with unit rentals, Graeme, is that, tenants just can't afford to keep paying these big numbers for units, in terms of rent. But Sydney, $750 and steady over the month. Melbourne, we're really seeing a strong revival in the rental market. Of course, Melbourne was probably more affected by COVID than any of the other capitals. And it's been tracking until recently as the most affordable market for rentals. Can you believe it? Australia's second biggest city, with house rents there at $560 now, but now above Adelaide at $550 and Hobart at $540. But another increase in Melbourne rents for houses, up 1.8%. Brisbane steadied a bit over the month, down by 5.7%, and Adelaide up, Perth reasonably steady, and Hobart down. I think it's interesting when we look at the annual growth rate. That really tells the story, with Sydney and Melbourne still higher by nearly 20%. Well, certainly Melbourne nearly 20% and Sydney nearly 15% higher. Brisbane eased a bit with with that lower result over June, but still higher by 7%. Adelaide up 12% and Perth up 18%. So some better news, Graeme, for tenants there. Just some very early signs, perhaps, that the market's not outrageously out of control, if you know what I mean, in terms of rent increases. But I do think, we need to wait for another month to see whether it isn't just the holiday effect, the June holiday effect, that's eased the market. And really, I don't think there's any good news there, for tenants, to be quite honest. But we'll wait and see. Now, again, when we look at the unit rents, hang on, let's go back to unit rents. So we've still got unit rents at $750 a week there, up by 3.4% over the month. Melbourne unit rents up 6.8%, Brisbane up 1.8%. So the relief's really been about houses rather than units. I think I missaid that just before, but nonetheless, we're certainly still seeing strong demand for units. Sydney unit rents are now tracking houses, and you can see the results over the past year for unit rents. Look at those results in Sydney and Melbourne.
I've never seen anything like that in my life.
Well, as I said, we've got to understand that that's coming from a very low base, which was driven by those factors I mentioned in COVID, right? I think the interesting one is Brisbane there, where we've seen unit rents increase by 24.4% over the past year. So up by nearly 25% over the past year. Brisbane rents. We know that was also due to COVID because of the surge out of the southern states, Sydney and Melbourne capitals, which had severe lockdowns, and that encouraged a strong migration effect into southeast Queensland. Of course, that meant higher rents particularly, and we can see that result there with unit rents in Brisbane up by 25%. But again, look at these vacancy rates. Even though they eased even though rents were higher, rents were higher, vacancy rates were higher too, which usually doesn't track that way. But again, it's just really underscoring when we look at those vacancy rates, Graeme. Canberra and Hobart have the highest vacancy rates for units at 1.4%. Melbourne's still a market which I think's got some catch up in terms of units, even though that vacancy rate at 1.2% is very, very low. You can see it in relation to the other markets that it's still probably got some upside as far as rents are concerned. And look at the Melbourne unit rent, Graeme, and it's the same with houses. It's $550 a week versus Sydney $750 a week. Now that's $200 a week, the difference per week that a Sydney unit tenant is paying versus a Melbourne unit tenant.
That's 10 grand a year, Doc.
That's right. And the incomes aren't that much different, Graeme. This is the point between Melbourne and Sydney. Sydney has marginally higher incomes, average incomes. So it's obviously struggle street there for Sydney in terms of trying to find a rental property, having to pay that $750 a week and seeing these types of, almost non-stop increases from month to month, So again, a sobering result there for units over the month, and the annual growth rate. And of course, we know that units are becoming, because of affordability, because of lifestyle preferences, are becoming more popular in terms of a housing choice. And this is the big problem: is if we're seeing high levels of demand for units and we're not building more units, what happens? And this is what happens. We get higher prices and higher rent. So that's the rental market, Graeme. A little bit of relief on the house side of the equation, perhaps in terms of the holiday impact over June, but we all wait to see whether this will work its way again into a trend when we get the July numbers. But I wouldn't be holding my breath too much if you're looking for some relief. It's going to be a hard road for tenants going forward, I believe, because of the mismatch in fundamentals. But also, at least it's some positive news, and I don't want to be, treading on people's here, but in terms of the landlord, because the landlord can certainly know that their product has plenty of demand and potential for increasing income in an environment where interest rates have been rising, although I'm sure investors and landlords will be happier with the pause that we've had in interest rates announced for July. So we mentioned house building costs, Graeme. And again, this is we've discussed that. This is one of the key factors in our undersupply, our chronic undersupply of homes. We've had some sign of relief. We've got the National Quarter house building costs increased again over May. So although they're still increasing and remain significantly higher compared to the same period last year, certainly we're starting to see the rate of growth decline. So some better news there. And that's really because we've moved past that home builder surge. There's less work around, so there isn't the same shortages in tradesmen and materials that we've had, tradespeople and materials that we've had. So we're seeing some easing in growth. So that's the chart, Graeme. that shows us so this is quarterly house building costs. It's derived from ABS stats created through My Housing Market. And you can see there that it's just, look at that incredible leap forward the index had as a result of home builder. I mean, that's just crazy.
Wow.
You can see how steady it was prior to that, but it's just gone through the roof through home builder. And certainly we haven't seen a consistent period of higher building costs because of that. But it's, one-off factors we could never have predicted. The previous government would probably had to do something during the depths of COVID because it was such an uncertain economic period. And of course, the go-to in Australia is typically the housing market and home building, and that was what generated the motivation for the policy. But of course, it has really impacted building costs, and of course, that's impacted inflation going forward. And now it's going to have a longer-term impact on making it even harder to match supply with demand with new building levels. But the rate of growth eased again over May, but the results still remain at high levels and are certainly placing pressure on home builder profitability. You can see there, that's the annual rate of growth of the quarterly indices, Graeme. And you can see how it's clearly falling away now from its peak there of nearly 25% a year ago. And now it's down nearly at 11% growth. So a certain improvement there over the period now, but still very, very high growth in building costs, 11% compared to what they were a year ago is a struggle for builders to be profitable, and that's the bottom line here. So we're going to have a quick look at our capital city regional markets, how they've been performing, Graeme. So let's have a look at the Sydney region. So these are the capital Sydney city regions. So we'll look at some of the hot spots here, and this is for houses. Inner West, there we've seen a strong performance there. This is for the June quarter. House prices in the Inner West up by 5.6% over the year, 3.8%. Unit prices have also been a strong performer in the Inner West over the June quarter, up by 6% and up by 3.6% over the year. The Lower North has had some good results there for unit prices, up by 10% over the quarter, Graeme, 4.7% over the year. And the Northwest has been a very solid performer. The Hills District there, Graeme, up by 3.3% over the quarter and up by 3.9% over the year. But you can see most regions reported higher house prices over the June quarter. And of course, we know Sydney market's been up and running over the June quarter overall. So yeah, Inner West and the Northwest for houses, the Lower North and the Inner West for units were the best performers in Sydney over the June quarter. In Melbourne for houses, we saw the inner city, the inner urban area, best performer for houses up by 6.2% over the quarter, flat over the year. The Outer East, which is always a strong performer, Graeme, was again leading the pack, up by 11.1% over the quarter to be up by 2.2% over the year. And the West was the best performer for units, up by 0.7%. And over the year, 0.6%. Houses certainly outperformed units over the June quarter in Melbourne, Graeme. As I said, I still think there's plenty of upside, particularly for that Melbourne unit market with all the migration coming in, particularly students coming into that market. And I would expect to see a rebound in Melbourne units over the second half of the year. But houses are certainly doing quite well, particularly the old favourites there. So yes, the West has been the best performer in a very subdued market over the June quarter for units in Melbourne, Graeme. And different story here when we look at Greater Brisbane regions, and we'll look at the whole of Greater Brisbane, including the Sunshine Coast down to the Gold Coast. Strong results. Look at Brisbane units, Brisbane City units there, Graeme, up by 2% over the quarter, 7.1% over the year. Ipswich, strong performance there. over the June quarter for houses, up by 3.8% and 3.7% over the year. Moreton Bay did well in both houses and units over the June quarter, Graeme.
Moreton Bay is crushing it, Doc.
Absolutely, mate. And across the board too here in terms of units and houses. So 4.8% up over the quarter, 2.7% over the year. And this is really reflecting the revival we're seeing over June in terms of the Brisbane market, which, of course, following a very strong boom, eased last year, was the last market really to ease in terms of the adjustment from the COVID boom. But these are indications with these very positive results for Moreton Bay and Ipswich, particularly there for houses. And Moreton Bay also strong in units, Graeme, up by 7% for units over the quarter and 9.2% over the year. Of course, not as much unit building goes on in Moreton Bay as it does in Brisbane City, but certainly there's an appetite for units in the greater Brisbane area. When we look at the regionals, look at the Gold Coast again, really doing well in terms of unit performance, 5.5% increase over the quarter, Graeme, for Gold Coast units, up by 6.8% over the year. And Noosa Heads has really cracked it in terms of house prices there. Look at that median of 1.2 million there for Noosa Heads. House prices up by 16%. Smaller market, of course, but up by 16% over the year. So there are our regional updates. You see it first here, Graeme. And I think that, there's some positive news we can see going forward and some interesting results there on a regional basis. This is capital city regions, of course, and looking at Brisbane as greater Brisbane from the Sunshine Coast down to the Gold Coast. So we mentioned our auction markets, Graeme. Bounced back surprisingly strongly last weekend despite school holidays. Strong results across the board. Underlying strength of which is really reflecting the underlying strength of those mid-year markets. Really, almost. I think we were a little surprised, Graeme, when we saw those results. We've been discussing the prospect of a quieter winter period, but just shows you these markets. On last weekend's results, have plenty of upside to them still, despite the winter chill. And Sydney, 77.4%, Graeme. Seriously, I mean that's nearly another. That's
plenty for sale and plenty is selling.
Well, that's right. We had 100 extra properties come into the market, 25% increase in properties. Nearly a 30% increase in properties in Sydney. Still, we had a 77.4% clearance rate. It's interesting, Graeme, because most of the properties that are going under the hammer in Sydney and Melbourne now are mid to lower priced properties because the top end of town, they're all on a break and they are really inactive during July and August. So it shows you the appetite's there for lower priced properties, and perhaps that's a reflection of the sort of the value perceptions that buyers have, and also maybe migration is starting to impact some of those outer suburban properties as well in Sydney and Melbourne. But as I said, strong result. Melbourne 72.8%. I mean, it's really was even the last two quieter weekends. It was still around 70%, but it's bounced up to 72.8%. Again, an extra 100 auctions in Melbourne. Brisbane had quite a nice result there, 64% clearance rate. Adelaide back up in the 80%, and Canberra as well improving. So it was a little bit of a surprise, Graeme, to see how strong the market is, but we shouldn't be surprised given the strength of the autumn selling season that we're continuing to see it through the winter period. And as I said, it's interesting because a lot of these sales are those lower priced properties because there's much fewer higher priced properties in the market during this period. So when we look at the big picture, slightly down over July to date because we had that weaker start to the first weekend in July for Sydney, but still tracking above 70%, Graeme, which is clearly still a seller's market. Similarly in Melbourne, flattened slightly, but still a seller's market. Brisbane down a little bit, but it started the first weekend very quiet with a very low result for Brisbane, but starting to pick up. Adelaide back up into the 80%. and Canberra holding in the mid-60s. So it will be very interesting to see what happens this weekend, Graeme, whether we maintain the rage. So I know you have bated breath waiting for next week's results, Saturday's results. So everybody look out for those results, and we'll discuss them in depth here next week. And also next week, we're going to have a look at a couple of different models next week, Graeme, just to spread it around a little bit. We've got a new measure from the Reserve or from the ABS on household spending. They're now doing a monthly report on household spending. And, of course, that's important because it reflects whether interest rates are putting pressure on consumers. So let's have a look at that new measure of household spending. Also, we've got the latest overseas arrivals data. So we'll have a look at overseas arrivals just to see how that pattern, because that's a bit more current than the migration data that we get, which is typically a little bit backward looking. The overseas arrivals, which just looks at visas, the approval of visas, temporary visas, permanent visas. So we can see how the trend there is in terms of overseas arrivals. We mentioned home building commencements. So we're going to have a look at that. Again, a little bit more interesting. And, of course, we're going to finish off, as usual, with the latest weekend auction results. So not only do you get the latest news first here, Graeme, but you also get all those little bit of extra news items which add to the jigsaw puzzle about what's happening in our housing market. So look forward to next week, mate.
Absolutely. And just to put a bow on that, Doc, if you have been living under a rock, ladies and gentlemen, Doc has finally shared his app with us around his live real estate data.
Yes.
So if you are a general listener, unfortunately, we have that password published in our private Infinity community group on Facebook. So if you are Infinity family, I strongly encourage you to jump onto Facebook in the private group. The password is there, and you can all send Doc a little thank you message on this YouTube session in the comments below. So as always, Doc, I'm very, very excited for the data to come out. And
yes,
from what we can see here and how we can interpret it without any agenda, it's still pretty confident and buoyant.
Yes, it is, Graeme. And I think the important thing about our little app that we have now is that it gives you at least the starting point in terms of a tool set to understand on a suburb basis just what's happening now in terms of the listings market. And as I said, it's knowledge is power, and this is just part of that process. If you are in the market or thinking of being in the market or just wanting to know what your house is worth, of having a robust and reliable and real-time app that we're offering now through Infinity. So good stuff, mate.
Appreciate it as always, Doc, and look forward to seeing you next week.
Thank you, Graeme. See you later.
Thanks, Doc.